Welcome one, welcome all. A little pop-up stream to get the day going. We got a couple of very fun things we're going to do today. We are going to talk about wrapping up the year of 2024, some of the biggest trades, and look at what's left for us to take on this year. Any winners that will win into the holiday season, we will discuss today. We're going to give you a little taste of the 2025 stock market playbook, and then we're going to wrap this show up with some passive income strategies and vehicles to achieve them that are entirely done for you, for those that are a little newer to the scene. I'm joined by two handsome gentlemen here. Say hello, wave hello to the good people of the United States of America. Showcase yourselves in any way in which you see fit. Welcome if you're joining us from Twitter, YouTube, or any of the other places we're streaming this. We're glad you're here. Let's get right into it and give you a quick little mini recap of what we saw today, because I think today's price action was indicative of what we're going to see through the end of the season. A little bit of consolidation today. If you joined the stream on Monday, where me and Stock Savvy Shy broke down your SPY options trades, both bull and bear, you made about 60% on the way up and 100% on the way down. Just two trades. You only need to analyze once, and then you should trade it twice. We did fall off a little bit. There's a key level right here, this 598 and change. It looks like in after hours we did pick it back up. That is going to be key to seeing continuation on the S&P through the following week. We had NVIDIA lagging behind to start the day, but it seems as if it did pick back up through the end of day. I'm not sure if it held up. I haven't had a minute to look. Let's take a quick peek here. See if NVIDIA came back. Boom, best case scenario. I'm still holding a majority of my NVIDIA position, but I've sold passive calls against that position. Looks like I made a nice fat check today, even though the stock price didn't move. That is a delightful treat. So with that, I'll hand it over to my two co-hosts here to talk about any names they want to cover in the market. Shy, I know that you wanted to break down a little bit of the 2025 playbook. Are there any names you wanted to start with?
Yeah, so I think as we enter this light volume period of the year, typically there is some seasonality strength in the market, especially when the trend has been this strong. It's going to take a lot for it to kind of do a U-turn. It's not going to be a macro data related. It's going to be something black swan geopolitically, but you can't factor that into your decision. So I think a lot of people, knowing that it won't be as rough for the next 6 weeks, their eyes are going to be focused on 2025. And I think you've seen that rotation kind of occur in the past week or so, where a lot of the clear winners of 2024, the semiconductor names, big tech, like all these easy, I won't say easy, but these clear winners this year are lagging the market. The breadth is widening rapidly, and it's kind of going towards those lagging high quality names, those small cap names, because the Fed is on our side as we enter the year. Trump becoming president is very pro-business. And a lot of the appointees are from Trump is very pro-tech, pro-Silicon Valley. So I think a lot of people want to kind of get as much alpha as possible in this risk-on environment. And that's not in large tech and semiconductors anymore. That move has happened. Now it's towards what's next, and that is software. So Austin, I do want to bring up Snowflake, because I do think that is one of those lagging high-quality names that went through a massive narrative pivots just a week ago, and I think the run is still going to continue in this name, especially when you saw that 32% gap up. There was somewhat of like squeamish selling afterwards, but like not really. It's kind of basing. It's validating the move. And even when there was a sell-off today in the market on a lot of the risk-on names, Snowflake was kind of strong, showed some relative strength, and it closed at the high of the day. Like, I think this is one of those names that a lot of people were underexposed in and want that exposure in 2025, because the reason that people want to front run 2025 in the month of November, December, cap gains purposes. Like you kind of want to get the winners before the year starts, and you don't have to worry about all the cap gains noise in 2025. I do think Snowflake is kind of one of the best options for that, especially when are they still red for the year? Let me double check. I do think they're still down 13% for the year, and they are trading at a very undervalued valuation against their comps. My fair value on Snowflake has always been it's 215. It deserved to be 215 as soon as that narrative change is going to occur, and that occurred already 2 weeks ago. So I think we're going to kind of trend along that path. But we're seeing like names like Snowflake catch major bids. You're seeing names like MongoDB catch a major bid as well. That's a sympathy play to a Snowflake. Very similar narrative issue they've had the past year or so, and now the environment's improving drastically. So I do think Snowflake is one of those names where if you miss it, you're going to miss a massive move. It's getting re-rated.
I'd already missed it. That's the thing. Equity position, you have it. Guys, look, when you find these undervalued players, this is just one contract, right? This is one option. 928% from here to here. Timing, I hate when people say, you can't time the market. You absolutely, oh, there he goes. He's gone. You absolutely can time certain elements. You said it best. Fundamentals teach you what to buy. This was a clear opportunity, right? So when we were on live stream pounding the table talking about this, clear opportunity, fundamentally speaking. Then I get involved and we say, hey, technically speaking, these match up. We're looking good as gold here. This is gravy. We're buying right off of long-term demand zone, right? 109. Great opportunity. Again, I stopped what I was saying. Shay has said it best. The fundamentals teach you what to buy. The technicals teach you when to buy it. So the fundamentals are guiding us on what we should be exposed to. The technicals are telling us when it's the appropriate timing to do said things. Right now, there's obviously fundamental elements that are going to be incorporated, like macro market data, like what's going on in general markets. Is this industry overexposed, underexposed, overfunded, underfunded? We have to consider those things. But you can look at this on a company by company basis to understand this is a good name that is trading at not at a fair value. That's the problem. Warren Buffett, there's a reason the man was so successful, right? He knew how to go in and evaluate whether or not this company had growth potential and whether it was being valued fairly or not. And as a result, Warren Buffett has seen some of the greatest success of any single investor since the beginning of time. Why? Because he understood. Fundamentally, I'm gonna get into a good company that has a good trajectory, good growth opportunity, and a good market segment. And then what we're talking about here is adding in the technical element of understanding based on this chart where we know there's demand, where we know that the price tends to swell, where we can create a clear cutoff point. Should the market not go in our direction, we can get in and go to Boomtown. So cheers to Shay on this one. That was your find. You absolutely nailed it. We'll get a light golf clap going there. Got a little golf clap, please. Support the team.
I think
there we go. Thank you. Okay.
Came back in just in time for the golf clap.
So, yeah, I mean, this is a great opportunity, and I would agree completely with you. The weekly chart holding up phenomenally well for those that are holding this. I know this has been a very, very popular fan favorite. Everything Shay said, he nailed, right? Gap up. We get a little bit of consolidation. Price tapers off on the sell side, but so does the sell side volume. Anytime we see that sell side volume taper into a stronger buying day, even if it's low volume, I will take that as a maybe. It's not a guarantee. Nothing ever is. But that, to me, looks like price washed down, and buyers said, you know what? We're not done yet. We've got more work to do here. And it would make sense, given that our gap fill would put us at 185. And then if you take a step back, this is when life gets really beautiful, when the technical analysis lines up with the fundamental valuation metrics like Shay just shared with you, putting this at, what was your target? I think it was 215.
Mm-hmm.
So when the technical elements line up, as you can see here, climb with the fundamental values that we see, that's when we're in for a beautiful day. And I would say that this is more than likely going to test 235 and then settle where? Between 2 and 215. Would you look at that? Technicals and fundamentals collide to create the perfect opportunity for us to capitalize on a market that is underappreciating a certain name. It's a beautiful thing.
Also, the re-rating doesn't have to be so binary where it happens once. We saw it a year ago with Palantir. That name got re-rated from a black box consulting company to enterprise AI winner. That re-rating was like the move that it had plus 300%. That wasn't really on fundamentals. It was a multiple expansion. Like the market was assigning a premium valuation in this name because it was showing signs of clear leader and winner of that second stage of AI, which is applications. Snowflake, if they can follow suit in the next quarter, showing clear revenue reacceleration, all the metrics are ticking back up and margins did bottom and SBC does improve, it's going to zoom up again because now the market's going to send even more of a premium valuation than what fair value is, which is 215. That's why I do have a 2026 target on Snowflake $300 plus. I think this move, this re-rating isn't just going to be a one-time. It's going to be a continuance, especially when like all the numbers they reported in this most recent print was just like, wow, it was just an inflection period. Now it's up to them to follow suit and continue that strength, but I am confident in them doing so. But if they continue, like this is going through a massive re-rating because it went from undervalued AI will cannibalize them to premium AI application winner. That spectrum is massive on the multiple expansion. Palantir is trading at 120.
Look at them
Yeah,
together. What do you see?
Yes, exactly. See right there, that's perfect because Palantir, that move right there, that's all multiple expansion. They were trading at 30 to 40 times free cash flow next 12 months. Now they're trading at 120 times. That massive move, fundamentals did help, but really it was just multiple expansion. Snowflake's trading at 40 times next 12-month free cash flow multiple. If they get a similar valuation as Palantir, which I don't think they should, but if they close that gap, that is a 2 to 3xer right now. So that's why I just think that it's up to them to continue to show that dominance. But this is going to be one of those names where the market is so frothy on software names that there is slim pickings on what's actually fairly valued and what's undervalued. And Snowflake's one of those few names on the list that everything's kind of lining up for. And it's one like everyone's getting that FOMO behavior to get that second stage of AI because they're underexposed in software. Now that's where you're seeing that rush towards those names, and Snowflake's one of those undervalued names that people want their hands on.
Yeah, and I think it's important to look at the parallels too. Like we talk about this all the time in the introductory stuff. Like volume typically precedes a change in price. It doesn't mean up, it doesn't mean down. It just means when more people come to the party, you can drive it in both directions. We're going to see more volatility. And I would say case in point right here, Snowflake on the Boomtown gap up, you saw record volume dating back 3 years on a daily basis. As far as daily close, record volume. I would then point your attention to February of 24 with Palantir, where you saw the same thing. Again, you talk multiple expansion story. We go 16 to 25, and that was kind of the beginning of the end of this run, beginning of the end of consolidation and the beginning of this run that's taken us at a 3x multiple of where we were at that time. So again, when the big boys come to the party and retail's already been there a while, it can be even more fun because that increased demand is something that typically in the last, I think it's a newer characteristic to the last 15 years, right? Where online trading becomes more accessible. And I would also argue that I've always wondered, weird thought here, but with these algos coming in and a vast majority of this market being driven by machine, period, I'm starting to wonder, like, how much does the variability of retail factor into that? Like, could this almost reckless buying at times, right, almost lead these algorithms to conclude that there is enough demand here that they should also start buying? It's like a chicken or the egg, right? And it just sort of funnels this upward cycle. Melt up, I think, would be the most appropriate word for it.
Yeah, I mean, it's a euphoria for sure. And
yeah.
I think Palantir is one of those names where institutions were violently underexposed. Like it was that outstanding shares are like huge. Like honestly, if I was an institution at the time, like it would take a lot for this name to run because of the amount of shares that are outstanding. And also the black box component of Palantir's business is a little difficult to comprehend. Karp is a very type A CEO that could be a little scary for a lot of institutions. But you saw that AIP, that bootcamp, was the validation they needed to enter that commercial space and enterprise space, and it just took off from there. So I do think Snowflake, the move, like institutions are backing Snowflake. It was an IPO darling a couple years ago. It just was 100. It had Palantir's valuation right now. Back then when IPO, like it was just a very, very expensive stock, and it just didn't deliver on the AI thematic because Frank Slootman was just sleeping at the wheel and didn't believe in it. Who knows what? But now they're just going through a narrative change. But I do think this is, again, frothy times in the market. Things are feeling way too easy. I have a couple buddies who are just joking about quitting their 9 to 5 because they're making as much this year as they have in their salary. I'm like, oh my God, this is craziness. The VIX is at a 14 handle. Everyone's heads are being bigger. Everyone's posting their portfolios online. Things should not be this easy. So this is why Gav, myself, and Austin wanted to bring two guests to kind of create this new tool for all the investors to have, because when things are this easy, you kind of need a widen out your skill set, because things will experience somewhat of a rug pull, because when it's tilted on one side of the boat, it tends to sink. Feels that way. And I think it's really important as we enter 2025 in a Trump-led presidency. Who knows the volatility that entails in him being president? It's going to be crazy. It's not going to be this simple. It's not going to be this easy. It's not going to be this lack of volatility. That you need to have every tool in your arsenal to really outperform the market. So I'm glad that we have these two guests on. Gav, awesome. I'm going to pass it to you. Should we let Eric and Rob up?
Yeah, let's bring them on. Look, what he's saying here is very simple. We got a lot of froth. Let's take a little off and let's put it to work without having to do all the work. I'm a big fan of what they do because of the passive element. You hand them the money, they do the work, they send you the check. It's mailbox money. So without further ado, I'd like to introduce Eric and Rob from WEEL, that is ticker WEEL. Here they are. Hello, gentlemen.
Hi, guys. How are you tonight?
Let me get this layout like this so we can all be seen and be heard. Gav, you want to give them the hard intro?
Yeah, welcome on, guys. And unfortunately, my service has been a bit shaky, so if I'm cutting in and out or all, Shay, Austin can jump in and take over for me. But it's really a pleasure to have you on. I know we've been doing a lot of spaces, and I wanted to do something where we could show visuals as well, because I know that every time we get on, you guys are trying to show charts and different items like that. And so I figured this could go a long way for the audience in their understanding of the product that you've created and what it does for people when it comes to income strategies. For the audience, as we get into this, we've been working with WEEL together for a few months now. You may have seen some of the spaces that we've done, some of the other items. This advertisement that we'll be doing here is a paid advertisement, and we do not make any endorsements or recommendations of specific stocks, ETFs, or strategies. Rather, this is an opportunity for due diligence, entertainment, and education, as are all of our shows. So please just know investing involves risk, including the risk of potentially losing your investment. And with that being said, we are going to dive into this income strategies done for you side of things that is going on with WEEL, and also with the ability for us to actually show people some visuals here on the show. So Austin and Shay were really alluding to this. You know, we've had markets that are getting more frothy. We've had a lot of people that are sitting on gains. I think they may be looking for some rotation. Then you also have a generation of people that have now really had their retirement funds really buoyed up by this market that we've seen, that can also be looking for, like Austin was saying, these done for you income strategies. So Eric, it'd be great if you could kick things off with just a quick introduction of yourself, the fund, the strategy here for people that are unfamiliar.
Sure, happy to. And thanks for having me. Happy Thanksgiving to everybody. Obviously, family health is most important, but we can also be thankful for a pretty good market year, almost no matter what you own in terms of equities. So I got the tail end of your last show. So and I kind of agree. It's been fun, but there's a little bit of froth, and hopefully Rob and I can provide a bit of education on our strategy. First of all, some background. I'm calling out of Columbus, Ohio, and I own Peerless Wealth, and we're a registered investment advisor, SEC registered. And I've spent my whole career, most of which was actually with Wells Fargo before I started Peerless Wealth, as a retail advisor, counseling investors on making good decisions about their money and managing their investments on a discretionary basis. And one of the biggest problems I see individual investors are guilty of is, it's emotional more than anything else. They get caught up in what's happening now, and there's a bias in the financial world called recency bias. And what recency bias is overweighting the recent past more than the long-term past. And I'll give you an example. I bet all of you listening could remember what you ate for dinner last night. Could you remember what you ate for dinner a year ago last night? No, you couldn't. It's too far in the past. So what investors tend to do is they tend to think that what's been happening recently, that's what their memory is, right? And so that must be some sort of trend, and it works both in bull and bear markets.
The phrasing is, this time it's different. That's what you hear always.
Yeah. Always. And I see this. I've been an advisor for like 25 years, and I'm not a market timer, but probably my best gauge of a market bottom is when I start to have a few of these clients call me that start to panic because they think that what's happening recently, the last few months or possibly the last year or two that have been rough, the headlines are all bad. And they kind of forget about the long-term averages of the market and that it trends up. They just concentrate on that recent bias, and they think things are going to keep going down. And now it's kind of the opposite. We've seen 2 really good years. In fact, they're about the same. Last year was up about 25% in the S&P. This year is up about 25% in the S&P. So you made 50% in 2 years. That is not normal.
But this time's different. It's going to happen again next year.
Right? Yeah, valuations don't matter anymore.
Yeah,
AI is going to change. Solve it.
Yeah. Or depending on which president you pick, that's going to guide us to 4 years of the Holy Grail.
Yeah, and that's another big one. Is assuming
the Ark of the Covenant has arrived.
Assuming the president is going to make or break the market. It has much less impact than most people think. And I'm going to give you a bit more of my background to kind of help wrap this up a little bit, and then we'll get into the strategy. I got my Series 7 license in 1999, pretty much right out of college. And at that time, Clinton was president, and he was president in 2000. And then 2001, Bush got elected. In March of 2000, the S&P peaked, and then we got 3 negative years in a row. By the way, March of 2000, that was the peak of the .com era.
Yeah.
So instead of saying AI, say .com, and we're back in 99. Okay? Because that's what it was. Anything with a .com after the name was skyrocketing. And PEs, the PE on the S&P 500 was something like 26, 28 times earnings. And in 01, Bush, a Republican, got elected. Well, 2000, we went down 9%. 2001, Bush got elected. We went down 12%. 2002, we went down another 22% in the S&P. So we had 3 down years in a row, 2 of which were right after a Republican got elected. So please don't think that Republicans mean market up and Democrats. It's not that way. There's too many other factors. The factor there was valuations. Okay, the tech bubble burst, and we had 3 negative years that combined were down over 40%. And that was the beginning of a lost decade. You may have heard that term before. Mm-hmm. What a lost decade refers to is a 10-year stretch where buying the S&P made you no money. And they're rare, but there's a few of them out there. Most people say, well, I'm invested for the long term. What is a long term? I usually define that as 10 years or more because 95% of the time you'll do fine over 10 years. But from 1999, late 99 to 2009, and remember 2009 was the tail end of the financial collapse, right? So you're going from a peak to trough, it bounced around in between, but you made no money. In fact, the S&P was 1,500 in early 2000. And it took till 2012 to get it back to 1,500. And that was primarily due not to a crappy economy, but because of high valuations. And valuations, and we'll talk PE ratios. That's the main one, although there's others. The long-term multiple average of the S&P is about 17 times earnings. It rarely gets above 25. Currently, we are now when we discuss PEs, the other term is multiple, right? Everything's priced for a multiple of earnings. So you have to, is it last year's earnings or is it next year's earnings? Well, either way, we're 29 times last year's earnings, trailing 12 months. And we're 24 times the next 12 months estimated earnings. Rarely does it get this. We're in like the top 10% of valuation periods right now. And a lot of that's due to the Magnificent Seven. And so there's other areas of the market that are not nearly that expensive. Now, for that 10-year stretch, small caps, specifically small cap value, emerging markets, and REITs all did fine. They had like 8 or 9% averages over that 10-year stretch, a lot closer to that, 9 or 10% S&P, because they were a lot cheaper. And valuations are a horrible indicator in the short run, the next 12 months. There's momentum, there's headlines, all sorts of other things. But over a next 10-year period, they're actually very reliable. Rob, I don't know if you can.
No, I mean, I can provide some color. You nailed it, because history doesn't repeat itself, but it often rhymes consistently. And I think what he's saying, the PE multiple on the SPY, it's factoring in a lot of the tailwinds that a lot of people are bullish on for the market. Like AI is going to be a massive tailwind, but the market's a forward-looking mechanism. You have to ask yourself what's being priced in right now. And if the PE multiple is being that extended over what historically is trending, everything's kind of priced to perfection, especially, and that's a lot of risk because there isn't a proven ROI yet on AI. All these billions of dollars on investments on hardware, servers, and compute. That's the easy kind of phase of AI where you're just trying to get as much material as possible to create AI products going forward. But that stage one is very easy. It's just blindly spending money. When you have to actually analyze the ROI and figure out what to do from there, that's when it gets difficult, and that's where
we
it gets
just have to
messy.
prove that we're participating is really what you're saying right now.
And then a lot of names will get re-rated towards the mean, which will drag the indices down, because now it gets all right. Now we have to be actually logical with our spend.
It's a 4% margin expansion story versus the 22% we originally estimated.
Exactly, 100%. So
yeah, and there's some speculation that the election results might lead to lower corporate profits, maybe some more M&A activity, maybe pipeline and drilling, and that's really, but nothing's happened.
Everybody's M&A back. Is it back?
And we could also get a bunch of tariffs that could lead to higher inflation and keep interest rates high. So, nothing's happened yet, but this is probably one of my favorite charts. Look at the one on the right. What that shows is on the horizontal axis is the trailing price earnings multiple. On the vertical axis is the next 10-year average annual return of the S&P based on where that multiple starts. So this is a little bit of a tricky chart, but I'll explain it. So if we start at periods of low price earnings ratios, let's say 15, that would be a slightly lower than average multiple. The next decades, and this uses like rolling 10-year decades over a 50-year stretch. So you see all these dots scattered, but you see returns that are in the 10% range and higher typically on all. And when you get in really low multiples, 12 times earnings, you get much better 10-year results because it makes sense. You're starting from a cheaper multiple. The next 10 years, there's room for multiple expansion. And on the tail end of the last one, someone mentioned multiple expansion. Well, if they start low, they'll probably revert to the mean, and you'll get good returns. Again, the short run, not a good indicator. Now, go the other way. If you start at like 25 and 30 times earnings, the next 10-year average annual returns look like crap. In fact, that's when you get your negatives and your lost decades. Now, I don't think this accounts for dividends, so we might be another couple percent higher, but it's still a lost decade when you look at starting PEs based on that high amount, and you can see a pretty clear trend there from kind of top left to bottom right. Now, the left chart is the same thing, but it's the market return over the next 1 year instead of the 10-year average, and that's all over the map because again, PEs are a bad short-term indicator, but when you go to the long term, there's a much clearer pattern. So this is titled Income Strategies. Both Rob and I think that we're not necessarily bears. My own portfolio, I'm not, I'm kind of a buy and hold, kind of a Buffett style. I own blue chips. I own S&P 500. I own a bunch of small cap ETFs and mutual funds. But then I have about maybe 25% of my portfolio in my own strategy. And that is an income strategy. Now, you could be interested in income for two reasons. Number one, you could be retired or, just need the income out of your portfolio. Number two, you could be concerned about a lost decade, right? Either one of those situations might.
I would go with that one because, look, a lot of the people here are, I would say, between 25 and 50 right now.
Okay.
And I would say I'm a good example, right? That's a concern for me. I'm 34. I have kids. I own a house. I've made great money this year. I don't want to be in a position where I sit in a flat market and eat crow and be disappointed.
Yeah. And I'm 49 and I love what I do. I'm going to do it probably more than 10 years from now. So I don't need mine yet, but I want to hedge against a flat market, a shit market, a low single digit market. And I don't want to use bonds to do that because those bore me a little bit and I can do better, I feel like, with my strategy. And this is another good slide. You don't want to stare
at the screen all day. Guys, that's like an important thing here. You don't want to just sit there staring at the monitor all day, in and out, getting ulcers. What he's talking about is very simple, managed. That's what I'm talking about.
Yeah, this is, Rob and I do quite a bit of trading to create the option income, but the investor has to do nothing. And this is one more good slide. This goes back 100 years, and it looks at S&P 500 returns on a calendar year basis. 49% of the time, they're over 15%. That's that right light blue bar. So about half the time, you get over 15% on the S&P. That's great. We're in one of those years. That's why I keep my money invested for those years. On the far left, about 19% of the time, you lose more than 8%. And those are bear markets. And if you're young, maybe you sit through them and you're adding money, that's great. But that middle bar, which is the remaining frequency, almost a third of the time is between -8 and +15. And that's a strategy that we believe that's an environment that we believe we can outperform using options to create income. Right now, the dividend yield on the S&P is 1.3%. It's like nothing. So if you're retired or need income, you can't really live on that. You can buy dividend stocks, maybe get 3 or 4%. Treasuries are 4.5. You can own rental properties. That's income, but that's not done for you.
And it's a nightmare. I'm in it right now, and I hate it. I hate every second of it.
Not passive.
I'm upset you even brought it up. I feel like that was the first one back.
You told me that before. And you can own REITs, but those are maybe 4%. So there's not a lot of these strategies. The last option, no pun intended, is you can use options to create income. Now, some of you may be familiar with the speculative side of options. That's when we buy put and calls. We'll buy a call to speculate on the upside. We'll lose our entire premium if we're wrong. We'll buy a put to speculate on something dropping. We'll lose our entire premium if we're wrong. Rob and I are selling those speculators those options. And we're creating that income. And we're not doing it on individual stocks because we're trying to control risk. We're doing it on sector ETFs and broad-based ETFs. And so our strategy, we've been running for clients for years, including a hedge fund for 3 years. I started doing this individually, client by client. And when we went to weekly expiries, it just became impossible to do all the trading. So with Rob's help, we pulled it into an ETF called the Peerless Option Income WEEL. And what an option wheel is simply starting with a cash secured put, writing it out of the money. And I'm not going to spend a ton of time on this, but if you don't know the basics of puts and calls, maybe you brush up on that on your own because this can get technical. But we start by writing a put. Writing is selling. We get income. We write it out of the money. So we have a buffer against the first few percentage points of loss. So we can lose, and we reset it every week to control the risk. You know,
So puts basically meaning I don't think the price is going to go down, but just in case it does, this is a stock I want to buy. So I get to get paid while I sit and wait. And if it does go down, guess what? I get to buy the stock I already like at a discount. And I got paid that little bit of extra premium on top for the right to do it.
Yep. Yeah, exactly right. In fact, Warren Buffett has been known to write puts because he likes to buy things at a discount. And sometimes he wants to wait for his price. So you could have a $200 per share name. Maybe we want to buy it at 194, right? So that's our strike. The risk on that is it doesn't drop to that and it gets away from you and you miss out on the upside. But that's why you have other things in your portfolio that don't have upside caps.
And you keep that premium.
Yeah, you keep the premium. We annualize premium usually in the mid-teens, around 15% annualized when we take the weekly and we annualize that out. Why do we do weekly? Best way to explain it, you know, if I'm taking a road trip, if I have a 5-hour road trip, I have a lot more chance of getting in an accident than if I have a 5-minute road trip. I'd rather take so I'd rather write a weekly and reset every week than go out way long term where I can have maybe a nasty bear market. And so if we do get assigned that name, you're exactly right. We buy it at a discount. Then what we do, it's not bad if that happens. Then we own it. Then we write or sell a call against it, and it becomes a covered call strategy. I think a lot of investors might be more familiar with covered calls than they are with cash secured puts, but they're very, very much related. We write a call, and we typically write the strike price where we got it assigned. We just wait for it to come back. This is why we do it on ETFs, not individual stocks, because individual stocks might not come back. They could just keep dropping. Good ones, of course, will, but we use ETFs so that we don't run into the problem of going down and taking forever to come back. Then it gets called away and we're back up top again, and we just keep recycling this methodology. It's a very sort of rules-based disciplined system. We're not doing any sort of timing or technical analysis. We're just writing options against basket of ETFs. It will lag a little bit. When I say lag like the S&P. It'll lag in a strong bull market, but we'll still do fine. We're paying right now a 60-cent per quarter dividend, and we came out at $20 a share in May. We're at 20.84 now, plus we paid 60-cent dividend. So that's like a 7% return in 6 months. We try to create 1 to 1.5% yield per month, but mostly with option premium. But these are cash secured puts. We in case we have to buy, the money's there in cash, and that cash is in treasuries paying another 4.5%. So we're making money there. So this strategy does not need markets to go up to make money. That's the whole point of it. It's designed for in a flat range bound market. It'll likely be your best performer. No guarantees, obviously, but that's what the profile of this investment is. In a sharp down market, we will go down, but likely a lot less than the S&P. Case in point, 2 or 3 months ago when the Japanese yen carry trade sort of unwound, there's a couple other headlines that came out during that time. We had a little bit of a mini panic. The S&P actually dropped 10% from peak to trough in about 3 weeks. We were down between 4 and 5%. So this is going to have more downside protection, not total downside protection, but more downside protection, and it's going to create income regardless of if markets are going up. So maybe that's Rob. Did I miss anything?
Yeah, if you don't mind, I'd like to talk a little bit about the portfolio construction and how we assemble this. So as Eric stated, we're completing this WEEL process, but we're not just doing it on 1 or 2 vehicles. We're actually, if you were to look at the S&P, let's say it's 28% tech, it's 7% financials, it's 3-4% energy, right? We're creating a lot of what that picture looks like, but breaking the portfolio down into its piece part components. You could, if you wanted to, take an allocation, whatever your size portfolio is, and just do this on SPY, right? But if you were to analyze, and this was part of how Eric and I developed this through both forward trade testing and back testing, you're actually not going to find a whole lot of premium there. If you basically deconstruct the sectors and look at how a lot of these components are trading in and of themselves, you can build up more premium trading those constituents. So we look at different things like, where is it tech earnings week? So there's going to be a little bit more premium that week in our portfolio, right? What does that mean for the balance of how things might look? Should we beef up energy a little bit more? And through time, and again, through back testing, we really think we've found a formula that, again, is super mechanical. We wanted to take a lot of the thinking and emotion out of this and let the math and that portfolio construction work in our favor. So it's actually not, 1 or 2 or 3 wheels. It's a lot of components of the market, and I can pull up kind of a sample slide of how we construct. You can see a couple of the constituents here. This is not always changing. It might fluctuate a little bit with, say, where volatility is, or like I said, where one certain particular component of the market is, but we don't like to fluctuate a whole lot or deviate because, again, we're not going to try to be too smart for ourselves or overthink this, right? The math works. Again, as Eric said, we don't want to get too deep into options math or deep into options theory, but when you're buying options, you've got a lot to overcome. You've got to get the direction right, you've got to get the timing right, and you've got to get that decay of the contract right. And when you sell options, again, we're selling out of the money options within the confines of our AUM. There's a lot of things going for us, when we have a tailwind rather than trying to overcome a lot of the headwinds of how that looks. So you can see here, we got some gold, we got some, materials, we got banking. We have a lot of people, when they see this, they might poke fun at something like a ARC or a KWeb, but those are, if you look at the individual holdings of those, again, there's a lot of premium. They're slower moving than you might think. They're diversified. They add some premium to our portfolio. We actually don't get put those a lot because of the short time frame we're taking. And again, it's, they use a lot of higher beta names within those, but within that envelope, it's a diversified product that we get to trade to add some premium to our portfolio. So I think ARC, Eric, we've been put ARC maybe twice this year, even though it spent a lot of the year down. Of course, it's had a nice rally here recently, but it spent a lot of the year down, and we were just selling a ton of premium in that name and performing quite well. So.
Yeah, and the other issue is from a correlation standpoint. Probably the biggest few areas that we might be different than kind of just S&P weighted would be what Rob said, the ARC, but I'll mention 3: the KWeb, the GDX, which is the gold miners, and OIH and XLE. Those are both energy. Those 4 are probably overweighted compared to the S&P, and they're actually pretty aggressive by themselves.
Yep.
But when compared to like SPY, their correlation is low. Their correlation to SPY, all those things I just mentioned, ARC not included, are like a 0.3 correlation. A 1.0 would be perfectly correlated to SPY. And most of the other things in there are, 0.7, 0.8. They're kind of moving mostly with the market. But energy, materials, and for whatever reason, Chinese tech are very low correlated. And that's a key component or a key factor, because you don't want to get assigned all your names when the market drops. You want to kind of just keep things balanced, and that just helps reduce risk. And I would say that we run a very conservative wheel. You can run an aggressive wheel by using closer strikes to create more premium, but then it starts to look more and more just like a long S&P strategy, and you might as well just be long and keep it easy. This is more for, this will provide a nice cushion on the downside. We're confident, we can create more than bonds in a good market, certainly. And we'd like to think, we seek at least to create equity-like returns or more, 10, 15%. That's we say seek to do, not promise to do. But so I don't think, even though I don't need my money for the short term, I think I might do just as well or better in this than a typical equity fund. One thing before I forget, option income is taxable. It is taxable as regular income, just like T-bills and interest income are. If for those listening, if you have an IRA account and you have a taxable account and you have to pick one, pick the IRA, because then you don't have to claim that as taxes.
Perfect. Yeah, these are a lot of great comments. I think this is really helpful. It's interesting to me what you're saying there as well, that you could run, more complex. Obviously, this right here is the first Peerless ETF. Do you have plans for additional ETFs, maybe things that would run some of those more aggressive strategies, something on single stocks? Is that something you've thought about?
Yeah, we have thought about that. First and foremost, we have to grow this. It's 10 million or so right now. It's incredibly expensive to start and run an ETF. It's more than I bet most people listening think. And this isn't even to profitability yet. We're getting there, but we charge just over 1% on the expense ratio, which is actually pretty competitive when you look at these alternative, very actively managed option type of strategies. This is a strategy you'd see more in like a hedge fund, and you compare it to that, it's a lot cheaper. And this would be extremely expensive to do on one's own, because minimum option contract is 1. And if you're writing a cash secured put on a $300 per share name, you need 30,000 in your cash in case that fills. That's 1 position, right? So when you want to diversify to 10 positions, it's 300 grand you might need, and you only want to do this on 10 or 20% of your money. So the ETF, not to kind of sound biased, but for this strategy, the ETF really makes a lot of sense, because it's really hard to replicate on your own. It's very expensive and very time consuming.
Yeah, that's totally fair. This is something for people to chat about with their family around the Thanksgiving table tomorrow. I think everyone's talking Bitcoin, talk some WEEL. We've been running for a little bit over 30 minutes here.
Yep.
Would love to roll in to just make sure we've covered everything pretty well. I know we're going to do another stream or space in a couple of weeks here as well. So let me flip it over to you first, Rob. Is there anything else that you'd want to make sure people are aware of today and make sure we cover?
So really just, again, like as Eric said, if you want to do this on your own, there's tons of ways to do it. We certainly think this is a viable strategy. And if we were to just trade our own, this is how we would be trading. We believe in the strategy. We've done tons of testing, and have our money in it, have some client money in it, and really just attempting to grow this, and look forward to answering any questions. And certainly shoot us questions, Twitter, email, go check out our website, peerlessetfs.com. Tons of good info on there. Other talks we've done, some videos, the data on the fund, and reach out to us with questions.
And one more thing, don't fall victim over time to looking at the share price on this and forgetting about the dividend when you look at the historical return. 5 years from now, my expectation would be we'd still be around $20 per share. But we distribute that dividend out and you get it or you reinvest it to buy more shares. So you are compounding at double-digit yields, at least based on the current yield, but it won't show up in the share price. It'll show up in more shares, or it'll sweep to cash in your brokerage account if you're not reinvesting.
Yep.
Yeah, I agree. It's really important to point out it is something that not all retail investors are so familiar with, right? When they look at it, a lot of them do look at share price. And so I think it's important to lay down the facts of this is not where you should be looking. You should be looking at return rather than share price, right? And that's something that they do show now in a lot of these brokerages.
But yeah, we're probably out of time, and I just appreciate the opportunity to go over the strategy. And
yeah, great rundown. Thank you so much, Eric and Rob. Hope you guys have a great Thanksgiving.
Yeah, you as well.
Family, and looking forward to the next show.
Thanks a lot, Gavin.
Awesome. Thanks.
Awesome. Take care. Have a good